The election process is underway. The news headlines are red hot. People's tensions and emotions are high. This is a pivotal point in our country's future as we tend to become more and more polarized and more rides on each election that we have in the future. On today's show, we're going to be discussing how the election results could impact mortgage rates, the mortgage industry, and real estate investing as a whole. What's been going on in the last month regarding home sales and pending sales, what we're advising One Brokerage clients to do as far as rate locks, and how to know if you should contact us at the One Brokerage or somebody else to get a better deal. All that and more on today's episode of Mortgage Monday. Welcome to Mortgage Monday. Real Talk Real Estate here, bringing you the information that you need to finance real estate and save yourself money while doing it. I'm joined by One Brokerage broker, top loan officer, and all-around mortgage stud, Christian Bachelder. How are you today, Christian?
Doing good. Great introduction. Appreciate that.
Yes. So you and I used to do the show for Bigger Pockets. Now we're doing it under Real Talk Real Estate. I'm just curious, how much do you love Mortgage Monday being a part of your life?
I definitely dig it. I think it's cool, especially, I view it from the stance of, of the viewers having a place to go, that, sometimes we say now's the right time. That may be a little direction that we take in this episode, but sometimes we say, hey, make sure you're checking the right things. And sometimes I even give advice to the clients that they can use to shop against me, right? So just having a little bit of an unbiased, hey, here's the grit behind loan officers. Here's the grit behind the mortgage industry. Here's the stuff they may not want you to know, and ultimately it's just giving people another kind of bullet in their chamber, so to speak, to succeed in real estate investing, which I am very passionate about. And I like that Mortgage Mondays gives just a little bit more of an edge to our buyers and borrowers and even listeners, people who don't use us for their services, to potentially succeed. Even if it's 1 or 2% higher chance to succeed, I'll take that for our listeners.
Well, I certainly appreciate having you here, Christian. So thank you very much for sharing your expertise with our audience. Today's episode is going to be really good. We're going to be talking about what to expect if Trump wins the election. It kind of looks like things are moving that way. So we're going to discuss what you can expect if that happens, as well as what you can expect if Kamala wins. I recently learned how to say her name. I was saying Kamala and had some very angry people that assumed that I was doing that on purpose. I just didn't know where the accent was because I've heard it said both ways, but it is Kamala, not Kamala. Completely irrelevant to mortgage news, but I just wanted to say that if you've heard me say the name wrong, it was not a subtle dig. We're also going to be discussing the fact that rates have been going up and what we're doing with One Brokerage clients regarding rate locks. And then we're talking about home sales have gone up and why that may be. And if you stick around all the way to the end, you might just be rewarded with a cameo from the Mortgage Mutt. So let's get into this thing. Okay, first up, it's on everybody's mind, Christian. We are talking about the election. What have you seen from poll data so far?
Yeah, so this is not, I'm going to avoid taking a stance right or left on the aisle. But I can tell you what the market predicts. And they're pretty darn accurate. As of right now, we're rounding up the end of October here. The market is pricing in a Trump victory. That's what they're doing. Now it's going to be funny once this airs if Kamala wins, then I'm wrong. But it's not me making this prediction. Right. This is market data.
You're talking about what the markets are doing. The markets
That's
are predicting correct. Trump's going to win. Trump's up in the polls that these people are looking at. And you said something really smart. The markets are pricing in a Trump victory. So they're saying, look, we think Trump's going to win. And if that happens, we think this is going to happen in the economy. And so therefore, we are changing our loan prices in anticipation of that. Now, why don't you jump back in and tell us what they're doing?
Yeah, the best analogy I can make is, like when Vegas makes their line bets for football, football, basketball, they say the over-under is, whatever, 50 points, or, the Cowboys are a 3-point favorite, right? They're wrong sometimes, but good Lord, are they right a lot of the times, right? Vegas has gotten really good at that somehow. But that's basically the equivalent to what's happening here. The lenders are pricing in, that's the key word, a Trump victory. And why that matters is if we even track back to our last Mortgage Monday episode, and I know we missed a week there, but the one prior, if you guys go back and watch that, we were actually talking about how good rates have moved. They've come down a full interest rate percent in the last 2 or 3 months. These last 2 weeks, they've surged. They're up almost 0.75%. So if you were at 7, you're at like 7.75 now, right? 7.75. And the reasoning behind that, and this kind of goes against popular belief in a lot of cases, The banks believe that if Trump gets elected, there will be inflationary responses in the market. And historically speaking, Trump is really good at putting downward pressure on interest rates that has a long-term impact on usually inflation, right? If you artificially keep rates low for a long time, usually that will lead to a long-term impact of inflation. And we saw that in COVID, right? Right before and during COVID, we've been paying the last 4 years for what happened at that time, right? Rates probably should have never been at 2%, right? I think we can all kind of agree there. And now we're paying the counter for that. So banks are realizing that if that were to happen, they're kind of bracing. They're bracing that if the Fed has to pivot and re-combat inflation, they're pricing in this uncertainty up front. However, there's some potential good news here. Anything that is unstable or unknown in whether it's fiscal policies, economics, international affairs, anytime there's something in the financial markets that is uncertain or unstable, it always leads to higher rates because banks just don't like uncertainty. So let's play this out. And even if Trump does get elected and these predictions are correct, rates will probably at least temporarily come down after the election. Why? Because some of that uncertainty is gone, right? So just think about it. It's just like how you guys wouldn't want to invest in a stock if it's really volatile. It's why a lot of you guys may not like to invest in crypto. The really, the real risk people, the risk pro people, they're dumping all their money into crypto and they'll burn or fail, It's the same thing with these markets. A lot of these lenders just price error on the high side because they don't want to be in the unknown. And the moment things start to fall where they will, rates will probably start to stabilize a little bit. That's at least usually the case. But same thing goes, right? If Trump comes in and starts talking about we're getting rid of income taxes first week, hey, that's going to impact the financial markets if the federal government's no longer going to get federal income tax, right? So there's a lot of unknowns, a lot of uncertainty. We don't know what's going to happen, but I can report on what's happening right now at the absolute latest, and that's it.
All right. So when you say that Trump's policies are, how did you phrase it? Inflationary?
Historically, they've been inflationary, correct?
Yeah. So what you're saying is the way that the markets believe Trump is going to make economic decisions will lead to more inflation, which often means lowering interest rates or some kind of stimulus. Could be quantitative easing, could be something else. So whether or not he does that doesn't matter. The markets believe he's going to for this conversation.
That's the case. Yeah, that's exactly right. It doesn't matter what he does. They're projecting what they think.
And so because of that, they are raising the rates on mortgages now in anticipation that when he takes office, his decisions are going to lead to them becoming lowered. So if that is the case, you can expect rates to come down a little bit if Trump does get elected. We're not guaranteeing this. We don't know this. This is what, like you just said, the Vegas odds makers of the mortgage industry
That's right.
are anticipating. Now let's talk about what we're seeing today, because rates have been coming up from the refi boom that you and I talked about a little while ago. So what is a rate that somebody could have today that should reach out to us for a refinance? And then let's talk about what we're telling our clients that are now in escrow.
Yeah. So anybody who's in escrow right now, or, maybe writing an offer, within a week's, time frame here from getting a mortgage, we're locking them in sooner rather than later. Leading up to the election, we envision more and more instability, more and more rate movement, and we're locking in to be conservative. Whereas the last 2 months, we were kind of letting it in the industry. It's called floating your rate, which is leaving it unlocked until the absolute last minute because we were projecting downwards movement. This changes literally sometimes from day to day. If you guys remember our previous Mortgage Monday episode, we talked about the jobs report and how it came back higher than expected, which means more jobs were created. And that moved interest rates up because there's more people employed. There's more money moving through the economy. That leads to maybe the Fed wanting to stifle a little bit of that growth to limit inflation. It's all part of the big seesaw of the economy, right? Balancing inflation with unemployment. But just to answer David's question, right now we're recommending lock-ins. If your rate is still higher than 8.5%, I'd recommend refinancing. However, if you're in those sevens, you guys are the people that we talked to, in the last 2 months here when David and I were telling you guys to reach out to us. I think a little bit of that opportunity is delayed now. So if you're a 7.5, it probably doesn't make sense to refinance right now. This last surge of interest rates, these last 2 weeks, ate up a little bit of that. I would wait until after the election if I were you. You can still reach out, talk to us, get updates on where rates stand. But I don't think there's a beneficial move to make until the election does take place.
All right. So to recap this, if they're in the mid to high sevens, they should reach out for a consultation to decide if a refinance could work.
I would say mid to high sevens wouldn't make sense right now with the latest rate surge. I would say reach out and start planning the time that it does make sense and get on an interest rate tracker.
But what's a rate someone could have today where you're like, yeah, you should still refinance?
Above 8.
Okay. 8. If you're in the 8s, reach out. If you're in the 7s, say, hey, I want to be ready to pull the trigger when the time comes. And if you're in the 6s, thank the Lord, be grateful, be happy.
I'd keep it for now. That's right.
You've got a pretty good rate for now. There we go. All right. And as you mentioned, a lot of the One Brokerage clients, we are telling them to lock their rates because we think they're going to be going up, as opposed to float their rates because they could have been going down. Again, no one knows, but I think we're one of the few companies that will actually go out on a limb and say, we don't know, but that doesn't mean that we're going to be stupid and not even try to predict. Odds are you should hold off, or odds are you should lock. I always hated when I'd reach out to a loan officer and say, should I lock my rate? And they just danced around the question.
There's usually a leaning one way or the other. And now remember, your loan officer could be wrong, right? I was in that category of people during the jobs report. The entire market priced in that jobs report coming back. I think it was around 124,000. And we came back with like 280,000 jobs created, something like that, literally more than twice what we expected. Nobody predicted that. That was like way outside of what was even possible. So sometimes we're wrong, but you're going to be right more times than not if you track the market, if you do your due diligence, which we do. Stay up to date so that you guys as the listeners don't have to. Let us take care of it. This is what we do. It's our job, right?
All right. And the last thing we have to talk about is that pending home sales are actually up from where they were last month. I was surprised to hear that. And that's mostly because we're heading into the winter months where you tend to see home sales start to go down. Less people are putting properties into contract as you get into the holidays and the winter months, but they're up about 7.5% from where they were last month, which was surprising. And the inventory is also up. So, Christian, tell us a little bit about what you're seeing when it comes to the National Association of Realtors reporting that home closings are down, but CNBC reporting that pending sales are up.
Absolutely. Now, keep in mind, pending sales and closed sales, they're different metrics, right? So, closed sales are a lagging indicator, right? Pending sales talk about movement right now. Closings won't happen for 30, 60, 90 days following that surge in pending sales, right? So what David said is absolutely correct. We have an increase in pending sales. We also have a significant increase in active homes on the market. So inventory is up. So, if you just think logically, it would make sense that pending sales are up if inventory is up. And I think the number that I saw was 23%, which was published from NAR, the National Association of Realtors. Year over year, a 23% increase in supply, which is active homes available on the market. So obviously, and this is coming from me, not only as somebody who can read and report an article, this is coming from a buyer, an investor. I see some more opportunities out there, right? I see that there's more homes that would potentially fit my buy box. Even though rates are increased, I would potentially move on the right project. And I'm seeing more and more of that right project that are potentially coming on market, which I think is a good thing. We've talked about the golden handcuffs, people locked behind low interest rates. I think there's a little bit to be said just for seasoning of what people will accept for rates. Like if you go from a 3 to a 7, everybody shocks and goes, wow, we don't want that. But when you stay at 7 for 3, 4, 5 years, sometimes people start to accept it. Okay, this is what it's going to be. And they're more willing to potentially move out of those old homes for whatever reason they're moving and potentially add that back to the inventory of homes on the market.
Now, Lawrence Yoon, who's the chief economist for NAR, said that contract signings rose in regions all across the country as buyers took advantage of the combination of lower mortgage rates in late summer and more inventory choices. That more inventory choice is crucial here, which we believe, we're speculating, is because when rates go down, people are more likely to put their house on the market because as current rates go down, it gets closer to the rate that they had on their existing mortgage.
That's right.
So now they can get out of a low rate and into a semi-low rate versus get out of a low rate and into a high rate. Further gains are expected if the economy continues to add jobs, inventory levels grow, and mortgage rates hold steady. Regionally, pending sales were higher year over year in the Northeast and West and flat in the Midwest and South. And overall, the gains were biggest in the West, where home prices are the highest and buyers would benefit the most from even a small drop in rates, which is a great point. With rates now higher, like you and I just said, affordability is taking a hit once again. Mortgage demand from home buyers, however, still saw gains last week and was 10% higher compared with the same week 1 year ago. The levels of mortgage demand are still historically low, and sales, while higher, are as well. So even though mortgage rates are low historically, sales are low historically because sales were so much higher when rates were crazy low, and we all got used to that. With rates pushing back to 7%, the rebound in pending activity is likely short-lived and is unlikely to be enough to help 2024 home sales exceed 2023 levels, said the chief economist at Core Logic. So, Christian, for somebody who's sitting there saying, look, man, just tell me, do I buy or do I sell? How are you advising somebody to make that decision?
That's a loaded question. I feel like everybody is always case by case, but if it's just a rate comparison, like you said, if I should sell, what are you leaving behind versus what can you replace it with today? That's a pretty natural way to look at it, right? And if it's something where you got to move for work or you got to move for a divorce or a marriage or you have a kid and you have to upgrade, those are things that are just the natural cycle of life that you can't necessarily avoid with rates. But if you're looking to buy, I always give the same advice to everybody. Get knowledgeable about what it would look like to finance it. So that requires talking to me, talking to a loan officer, talking to a bank, and do your due diligence. Take, whether it's a course, you go on YouTube, study Big Pockets, study David, study whoever, and learn how to project numbers accordingly. Are you able to actually succeed with this investment? Yes, rates are 7.5%. Okay, well, people are overcoming that. I promise you, we see it every day. 7.5% doesn't mean nobody buys real estate, right? People are still doing it. We're representing them. What it does mean is that it's more difficult to succeed, which means you can't just throw, during COVID, you could close your eyes and throw a dart at a dartboard, buy that house, and it would work, right? It's very hard to fail in real estate at 2% interest rates, right? It's not that easy anymore, so it requires more work, which is why, David's always advising people invest defensively. Don't buy one house, try to quit your 9 to 5. That's not how you successfully do it. Maybe people got away with doing that in COVID because you locked in this really low rates, but that's not strategic investing. That's not good guidance, right? You defensively invest. You invest in markets that you see growth. You invest in markets that you could potentially cover that mortgage, whether it's short-term, long-term rentals, whatever. But to summarize everything, get knowledgeable about the debt, about the income, and about the opportunity, and rely on a specialist in each of those fields. So location would be someone like David or his real estate team. The financing would be me. Cash flow would be talk to an insurance agent, talk to your agent about what rental incomes would be, a property manager about what they would charge. Only then, once you can actually get all the meat on the bone and understand what the project is from beginning to end, then you make movement.
Christian, you've been in the trenches. How many loans do you have in process right now?
Quite a few. I think me personally, 60 plus. I think the whole company we're 200 to 250 right now. So we're surging a bit. Obviously, that probably comes from the temporary drop in interest rates that we experienced the last couple months. That we have some updates for you guys now today on how that's progressing. But yeah, pretty solid numbers for us. By no means are we all-time highs, but nice little pickup from where we were, beginning, middle of this year in comparison.
Yeah. Now, if you follow me on Instagram, I'm at David Greene 24. Christian is at _1_broker. You saw that I was like, hey, you need to DM me immediately if you have a rate above, I can't remember what I put, 7.5, 7.25, whatever it was. This is why. We had a temporary reduction. I hammered my entire database. I sent emails. I put it out. There were a lot. I mean, I don't think you and I did anything for a week other than try to communicate with people with refis and get them locked in to where they could save some money. And a lot of people did. If you're one of the people that didn't, I'm sorry. You probably thought they were going to keep coming down. We're going to be discussing today why that didn't happen, to inform you and educate you, because you will get another opportunity at some point, most likely. If you're not following me on Instagram, you would have never known that that's something that you could have done. So make sure you give me a follow at David Greene 24 and give Christian a follow at the One Broker, because we want to be able to save you money. And it was very, very busy. But before we get to that, Christian, you and I had a conversation I want to share with our audience. I thought it was really insightful. We were discussing what is the ideal avatar for a one brokerage client? Now, a lot of people don't realize this, but many people can do a loan, but not everyone does the same type of loans as well. For instance, there are lenders that can do FHA loans, or they can do low balance loans like what an investor would want, maybe sub 300,000, but their rates or their fees are higher and they're slower. Then there's other people that can do a high balance or a jumbo loan way cheaper than somebody else might be able to do. So your lender is always going to tell you what they can do, but different companies are situated in ways that they have a better price, fee, and rate for different loan balances. And you and I were kind of discussing what our ideal person loan balance client looks like. Can you share a little bit of where you think that someone should be to contact the One Brokerage, and where you feel very confident no one's going to beat us? This is our sweet spot. Everybody who's in this situation should come to us.
First and foremost, people who want the guidance. That's first and foremost, because if you're coming to us, you're probably looking for a little more than if you went to, like a guaranteed rate or a better.com, right? I mean, you're probably looking for somebody who invests themselves, who knows how to, pivot between different loan products. So, and segueing into exactly that, somebody who is looking to grow and scale a portfolio. So somebody who may start buying their first primary residence, may start buying a second home, may start buying their first conventional investment property, who will eventually need to pivot, whether that's into DSCR loans, into hard money loans, into bridge loans. And having one place, like your better.com lender doesn't do DSCR loans, right? Like Chase doesn't do hard money loans. Wells Fargo can't get you a bank statement loan, right? But having a place that you're going to have some point in your career in investing that you're going to need to systematically move through these loan products, that's our ideal client, because we can move with you, right? You can't outgrow us. We don't have a maximum loan to one person. We can do more than 5 for you. We can do more than 10. We have some people that we've done 20, 30, 40, 50 loans for, right? And that's I think really where we thrive, just being able to pivot, because we have so many investors that like so many different types of products.
Okay.
And we're not limited to just one bank or one underwriter's opinion.
So flexibility is a huge one. Guidance and consulting is another one. I think those are great points. I think we have a reputation as being the investor brokerage, and I think we probably are the best brokerage in the country for an investor.
Yeah.
But that doesn't mean that we are only working with investors. We are actually just as good if you're buying a primary residence, because we have rates that are super competitive set up for investors. You benefit from that when you do a primary residence. In fact, I think that those are even easier for us most of the time, and we're going to crush it compared to your standard loan officer that closes, 6, 7, 8 deals a year. Our guys are doing that in a week sometimes, right? You've got 60 going on in a month. But what about price point? What is the ideal price point for somebody that's buying a house, let's say primary residence right now, that should come to us? And at what price point are you like, hey, it's going to be much cheaper for us to be competitive at a certain point?
Yeah, I'd say first and foremost, people sub 100K loan amount, which is like sub 120 to 125K purchase price. Local banks are just going to beat us there, right? We're going to have minimum thresholds that our investors need. So we're going to have these minimum thresholds that our investors just need to maintain, a certain amount of profitability. And it gets harder when you have those really small loan amounts. So, there's nothing wrong with it. But if you're buying $60, $70, $80,000 houses somewhere in the Midwest, Detroit, Cleveland, something like that, there's going to be a local lender that is better serviced for you. They're just better positioned. They're going to have better access to that low loan amount debt. Whereas we're going to really compete once you get above 125,000. And I would say at the high amount, up to the jumbo category, the jumbo loan amount in your market, that could be, 700,000, that could be 1 million, that could be 1.2, 1.4. If you're in the conventional space, which means you're qualifying with your debt to income and you're looking for a jumbo loan, we have them. If you got $5 million in a checking account with US Bank, you shouldn't talk to anybody else besides US Bank. I'm just going to tell that honestly. They're going to intentionally do your loan and lose money so that they can keep your banking partnership, right? They want that $5 million in their checking account. So I would say both ends of the spectrum, the super high net worth, ultra wealthy that's just buying a primary residence, and the sub 100K loan amounts. Not that that's people less wealthy, just saying that's what they're choosing to invest in. Those kind of far margins of the borrower profile is probably where we start to get less and less competitive. But man, that huge piece of meat in the middle, that big chunk from the 90 to the 10% of borrowers, That's where we thrive. We're going to be really, really competitive in that space.
So if you want someone you can trust, come to us no matter where you are, because you're going to get honest work, really good consulting, and you're going to know you're not being ripped off.
And we have referrals. I have a sub 100K lender I can refer you to. We have a jumbo lender we can refer you to. We know people in those spaces that we don't service well.
And if you're looking for the cheapest, most best financial loan you could possibly get, if you're below 125 or so, we're probably not going to be as competitive as someone that specializes in those. And if you're over, say, 1.2, then you're most likely good going to a retail lender or a big bank. Okay.
Unless if it's a multifamily, then we can start getting tricky there. So 3 and 4 units up to like 1.5, 1.6, 1.7 purchase price. But yeah, it's a good rule of thumb. When you start getting into the mid millions, I'd probably refer you to a jumbo lender. They're local bank, somebody who, like I said, who will lose money on your deal just to get your banking relationship.
All right, Christian, if people want to get a hold of you, they want to ask you some questions, they want to apply for a loan or look into a refinance, where can they go?
Absolutely. As David alluded to earlier, at the One Broker on Instagram is a good way to catch me. Email's christian@theonebrokerage.com. It'll be down below in the video description. And you guys can always find out more about our company at theonebrokerage.com.
That is right. You can also check out the show notes to get more information about how to get a hold of Christian or I. You can check out the David Greene Show on Apple Podcasts or Spotify, or right here on YouTube for some more content. And you can keep an eye out for webinars that Christian and I put on real estate investing, financing, real estate, and creative methods people are using to make money in real estate today. Christian, thank you for being here. Before I let you go, can we get a quick cameo for our loyal listeners of the Mortgage Mutt?
I had to wake him up for his nap, but so he's not super happy. But Mortgage Mutt signing off. Mortgage Mondays. Have a good one.
There you have it, folks. This is David Greene for Christian, the Mortgage Mutt Bachelder, signing off.